A big rally on Wall Street today after this morning's tame inflation report, or tamer than expected inflation report. But some investors are still waiting for, quote, an inevitable downturn in the economy. Joining us now is Richard Weiss from American Century Investments. It's great to have you on the show. Welcome. I just put that in quotations, inevitable downturn, because I'm seeing that in your notes. Why do you think it's inevitable?
Oh, I don't think there's any debate out there in the economist community that we're into a downturn. We're headed into a downturn. Now, the debate is whether we actually technically hit a recession or it's going to be a softer landing. But I don't think there's any question, both domestically and globally, economic growth is decelerating. Maybe less so here in the U.S. than overseas, but it is a global economic deceleration.
Okay, so what do you make of today's rally then on the softer than expected CPI report?
I guess I'd say we're not lulled into a sense of complacency just based on one better than expected CPI print. And by the way, that CPI print is still well above the Fed's target, right? A 0.2% monthly run rate of core CPI amounts to an annualized rate of around 2.5%. That's still 50 basis points higher than what the Fed is shooting for. So we still need to see inflation come down significantly from even today's good print. Also, I'd argue we need confirming evidence, right? One data point does not a trend make. So PPI tomorrow, the next PCE report. I mean, these are the things we're going to be watching for to make sure that inflation is indeed on its way down. Else, rates are going to stay where they are, and we don't see valuations in the equity market compelling.
Okay. So it doesn't sound like you're ready to throw your target into the Fed rate cut debate that we were just having to kick off this show.
Right. Not quite yet. And you'll forgive me, you may be too young to remember, but allow me to quote that song by Metallica. I think it was back in the 80s, maybe 90s, No Leaf Clover. But that soothing light at the end of the tunnel may just be a freight train headed your way. And so that's what we're worried about. We'd like to see more capitulation in the equity market before we jump on the bull market bandwagon.
It's very kind of you to say that. I'm a big Metallica fan here, so I appreciate the reference. So if you're cautious or even underweight on equities, then where would you be putting money to work right now?
Well, high grade fixed income. Cash has been king for the last roughly 2 years. If you start from the beginning of 2022, we've been mostly defensive for much of that period. Cash is up about 5-6%. Point to point from the beginning of 2022 to now. Stocks, the S&P is down a handful of percent over that period, and equal weighted stocks and the Russell 2000 small cap, they're down 10 and 20% respectively over that period. So no question, cash has been king, and we believe, at least for the foreseeable future, is the prudent place to be. A bird in hand at 5, 6, 7% for high grade, shorter term grade investment, fixed income investments, relative to an iffy stock market at best, at questionable multiples, given all of the clouds on the economic horizon today.
Okay, so when you talk about fixed income, it sounds like you're talking about shorter term debt and bonds right now. You're not looking at things like, for example, the 10-year Treasury, where the yield just dropped dramatically below 4.5% today.
Right. We're somewhere in between. Now, our macro experts are still at the margin calling for a recession. I think we have a 60% probability on a recession. The longer end of the curve would be the place to be if that's the case. But I think we're a little more diversified in duration than simply legging out to 10 years.